The US-Iran war continues to stretch for the sixth day, showing no signs of de-escalation. West Texas crude oil broke above a key resistance level as expected at the 78.10 US dollar per barrel. And in today's Asia session, it continues to further extend its rally by 0.9%. Gold price yesterday came down, but managed to find support once again at the 20-day moving average for the XAU/USD at around the 5,040 mark due to conflicting factors, where positively gold could potentially benefit from a rising geopolitical risk premium. On the other hand, opportunity cost for holding gold rises as Fed rate cuts bets gets reduced due to rising stagflation risk. Over in Asia session today, the major benchmark Asia stock indices fare better than yesterday's sell-off in the US benchmark indices. The Nikkei 225, as we are speaking right now, is up by around 0.4% after that sell-off that was seen in the Nikkei 225 futures that managed to survive at the key 50-day moving average, which we highlighted yesterday at around the 54,100 mark. The Hang Seng Index continues to bounce after yesterday's release of a lower growth target for the Chinese economy this year at around 4.5%, as indicated by the top leadership in China. Very good morning to all and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. Today will be the Friday, today will be Friday, the 6th of March, 2026. So before we jump straight into the gist of the Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so let's have a quick start before we jump into, as usual, due to the current volatile climate, I will cover the full suite of the Daily Dose, which is comprising all the intraday technical outlook on those broad-based cross-asset classes. So let's have a quick recap of yesterday's event, more particularly centering on the ongoing US-Iran conflict. Okay, so let me share with you my screen over here. Okay, good. So there are some end of the quarter news flow that is coming out on the share is that at the moment in time, based on public speeches made by key stakeholders, apparently there is no signs of backing up. So yesterday, the Iranian foreign minister did a press, we call it interview, saying that if there will be any ground invasion by US, it will be a disaster. And what he also mentioned over here is that in terms of negotiation, so Aranchi, which is the foreign minister, saying that Iran is, okay, let me remove this. Iran is not requesting a ceasefire and that the country does not see any reason we should be negotiate with the US over here. We negotiate with them twice and every time they attack us in the middle of the negotiation, he said. So there is no request for a ceasefire by us and there's no request for a negotiation with the US from us, as being quoted by the Iranian foreign minister. So based on his speeches over here, it doesn't seem to us, or doesn't seem to me, that this ongoing conflict in the Middle East will get subsided very soon. And there could be a risk if this conflict gets stretched out for by the end of this week. Let's say at this weekend, there's still no heatwaves. There could be a chance that ground invasion got to take place because whatever US that is doing right now in terms of air attack doesn't seem to allow the Iranian to actually back down from here. So what does this imply on the global markets, which is very important, which I'm going to share with you bit by bit. So for sure, we know that oil prices will continue to go up. All right, so previously I mentioned that if oil prices continues to rise, there could be a risk that the inflationary trend in the US will also go up as well. All right, so what we could see over here is that this is a steep rise in the West Texas crude oil. You can see on my screen here, hopefully it's good. Yeah, so West Texas crude oil continuing to rise. And if you look past very clearly during 2000, the episode of the steep rise in the multi-month broad-based uptrend of oil prices or West Texas crude oil, in short over here, moves in line with this US 10-year break-even inflation and the 5-year break-even inflation, and it has some form of impact on the US 10-year Treasury yield as well. That is also moving in direct lockstep with the rise in the steep rise in West Texas crude oil at that point in time during 2021 to 2022. So at this point in time, this steep rise in oil prices is also due to geopolitical risk premium over here due to the Ukraine-Russia war. But this time around, this has much more impact because it involves oil-producing country in the Middle Eastern region, which is very, very key to the global oil supply. So if these Middle Eastern countries start to see an oil supply shock due to a potential Iranian attacks on their respective oil fields, that could create a much more persistent rise in oil price as compared to the Russia-Ukraine invasion at the Russia-Ukraine conflict/war at that point in time in 2021, 2022. But nevertheless, if oil prices continues to have a swift up move and it persistently starts to stay firmer, it could lead to the 10-year break-even inflation in light blue and the 5-year break-even inflation in dark blue to see coordinated steep rises as well, meaning that future inflationary expectation trend in the US will increase potentially, all right, given that the 5-year break-even inflation and the 10-year break-even inflation are derived from market traded instrument, the US Treasury protection bonds over here, indicating that 5-year inflation trend from today and 10-year inflation trend from today will inch higher. So if it goes to inch higher, what we could see is happening right now over here, that could actually deviate from what the Fed long-term desired of having inflation to be anchored at around their 2% level. When that's happened, the Fed ongoing interest rate cuts cycle will be an obstacle for the Fed to conduct further. And that has already been priced into the CME Fed Watch 2, which I shared with you guys yesterday, that the 2 interest rate cut probability is getting is still there from yesterday, but it's being pushed down the calendar, down the road to September to October instead of earlier June and July. But this time around, based on yesterday's remark by the Iranian foreign minister stating that Iran will continue to this, we call it continue to engage in hostility towards US, and US itself is not backing down as well until some kind of objective is being achieved, which Trump and the Department of War did not state out what other objective will be, and that conflict in the Middle East right now could escalate and potentially see firmer oil prices. And yesterday, I'll say that based on the latest price action on the Fed Funds futures contract, as compiled by the CME Fed Watch 2, has now shown that 2 interest rate cut in being priced in before is now showing signs of a lower probability. So if you were to look at the aggregated tab over here, so we know that previously the June has been greatly reduced, followed by the July only at 66% now. And right now, market is actually looking at the next interest rate cut, which will be the 4th cut so far in this ongoing interest rate cut cycle by the Fed, at 97% chance will be on the 16th of September 2026 FOMC meeting to bring the Fed funds rate by 25 basis point lower to 3.25% to 3.5%. Currently, it's at 3.5% to 3.75%. And what's interesting over here is that previously, yesterday, we do have about 70% for it to have a second cut for this year. In total will be that 5th cut in this ongoing interest rate cut cycle to be conducted on the end of the last meeting of this year, which is on the 9th of December 2026 FOMC meeting to bring the Fed funds rate back down to 3% to 3.25%. But however, that chances now has been reduced to 58%, getting lesser. All right, so it's almost about a coin flip. So what it means that over here is that if oil prices continues to go up, the chances of the expectation or the probability of the Fed interest rate cut for this year will get reduced. Firstly, it's being pushed down the calendar. Then secondly, it will potentially get reduced, and there could be a risk that there will be even no interest rate cut that is possible for this year, given the fact that if stagflation risk continues to rise, with oil prices hitting at that $100 per barrel. Right, so this is the current situation right now, and if this trend continues, there will be a potential liquidity squeeze into the system, the global financial system, which is not doesn't gel well for the US major stock indices, where all of them closed in the red yesterday. Despite the fact that during the last hour of the trading session yesterday, it managed to stage a bounce. So all four of them closed in the red. The SPX down by negative 0.56%, the Nasdaq down by negative 0.3%, the Dow Jones down by negative 1.6%, and the Russell 2000 down by negative 1.9%. And if you go across to Asia, Asia fared much better due to some individual factors, which I'm going to share with you guys later on. So the Nikkei 225 managed to inch up higher to 0.38% right now, as we are speaking, closing trading at the session high. And if you take into account of the Nikkei 225 futures, after yesterday's US session sell-off, because the Nikkei 225 futures is trading on Globex, which also take into account of the US session trading, which is initially they have that steep sell-off as well, in line with the US major stock indices in yesterday's US session. So therefore, it has a lower base. So once today's Asia session opened, the Nikkei 225 futures increased much higher to 1.51% as we are speaking. So that is also trading near the session high. And over in the Hang Seng indices, it also managed to stage a rally within our highlighted supports that we highlighted on the Hong Kong 33 CFD index that's representing the Hang Seng index, up by 1.46% due to the fact that this time around, the China top policymaker in the readout of the China 2 session yesterday, Premier Li Qiang mentioned that the GDP growth target will be lowered this year to about 4.5% to 4%. So that actually tells in line that there will be a rebalancing in the Chinese economic growth resources to put it with that China resources in allocation to derive GDP growth for this year. So we know that in the last 3-4 years, especially right after post-COVID, China GDP growth has been primarily driven by the external sector, which is exports. So they will actually rely less on export this year to actually potentially rebalance. So this is what is being implied towards other segment of the economy. And also yesterday, Premier Li Qiang, which I highlighted to you guys in the daily dose, that he subtly mentioned that one of the top key economic strategy for the China top policymaker to undertake in the next 5 years is to allow prices to rebound again and wages to actually increase. So this message was missing in last year's speech, last year what I call 2-session speech. So the China top policymaker has acknowledged the negative spillover effect from deflationary risk spiral if it gets to entrench in the Chinese economy. So that actually explains why the Hang Seng indices sell-off was muted yesterday on the intraday basis and managed to stage a bounce at our respective highlighted supports level. And that is also being, we call it expressed or play out in the China A shares, which is being, we call it monitored by me using the CSI 300 index, which comprises all the 300 big capitalized stock listed in the Shanghai and Shenzhen Stock Exchange, up by 1.16%. Sorry, up by 0.16%. Pardon me. 0.16%. The smaller China A50 is almost unchanged after shading off earlier losses and trading near the session high. And if we go down towards the other Asia markets, they are much more weaker, moving in line with the broader macro environment, where the ASX 200 is down by negative 1.28%, trading near the session low. The KOSPI continues to bleed, down by negative 1.85%. And bear in mind that the KOSPI 200 in the last 2 sessions on Tuesday and Wednesday, I think it shaded close to about negative 15% or so. trimming off is a spectacular gain that has seen so far this year. So year to date, prior to this week, we call it opening, the Kospi 200 is up by almost a whopping 40%. All right, so it's pretty much we call it a speculative unwinding, especially on leverage bet towards the Kospi 200 component stocks. And the STI continues to correct at down by marginally negative 0.19% over here. So it's rather a mixed bag of performance in the Asia Pacific stock market. Some of them are moving in line with the global macro risk-off environment, but however, the Nikkei 225 and as well as the Hong Kong Hang Seng Index are moving according to their individual positive factors driven from their so-called policy making by their respective, we call it institution or government bodies over here. So now I want to explain why the Japan Nikkei 225 is moving up at this juncture is due to the fact that given this rising geopolitical risk premium, there could be a chance right now or a rising odds that the Bank of Japan may tone down its gradual interest rate hike monetary policy stance. So, in the last 2 years, the Bank of Japan has gradually been increasing interest rate. At most, every year they try to actually do two interest rate increase, but due to this ongoing Iranian-US conflict that could create stagflation risk, that means lower GDP growth, higher inflation trend over here, the Bank of Japan may not be so aggressive or may not be able to find a reason to embark on their gradual interest rate hike policy this year. So instead of 2 cuts, they may even do only one. Instead of 2 hikes, pardon me, for Bank of Japan, they may only do 1 hike or even none this year. So that has been expressed by the yield curve over here. So take a look at this chart over here. Is an intermarket analysis between the JGB bond market, which is the Japanese sovereign bond market, and the Nikkei 225. So this is the 10-year Treasury, 10-year JGB yield, pardon me, 10-year JGB yield minus off the JGB yield 2-year. So it's a yield spread. So if this dark blue line continues to increase, it bounce, this daily chart going to bounce up higher, it means that the 10-year JGB yield is higher than the 2-year JGB yield, or conversely, the 2-year JGB yield is coming down at a faster rate compared to the 10-year JGB yield, right? Two instead happen. So take into account of the low of the Nikkei 225 since April 2025. So April 2025 is an inflection major bullish reversal low after that earlier sell-off due to Trump's, we call it global reciprocal tariff. Then thereafter, the Nikkei 225 continues to resume its medium-term and major uptrend phase, trading above the 50-day moving average over here. So what I could see is that this movement of the Nikkei 225 moved in tandem with the rise in the JGB 10-year minus JGB 2-year yield spread. And what's interesting over here is that, recently there's this sell-off that took, not sell-off, that reduction in the yield spread between the 10-year and the 2-year. That means the 10-year and the 2-year JGB spread starts to trade downwards back towards the 50-day moving average over here. Which is it's actually the 200-day moving average, not 50-day, the 200-day moving average. So that was on January, all right, January, okay, 20th of January, as it continues to trade lower, and it created a negative feedback loop on the Nikkei 225 after the Nikkei 225 hit a peak or all-time high on the 2nd of March at the start of this month, before that we call it that sell-off that's being seen globally on the broad-based stock indices due to the rising geopolitical risk premium coming out from the Middle East. So what we could see now is that there is a rebound that is being seen at the 50-day moving average again. And this rebound on the 50-day moving average comes in line with the rebound that is also being seen on the 10-year minus 2-year JGB yield spread. All right, so the yield spread has started to increase as well. So this yield spread increase over here, if you were to look into the configuration, because it's 10-year minus 2-year, the 2-year JGB yield over here starts to show a series of lower high. That means it telling us that the 2-year is actually reducing. All right, so with the reduction in the 2-year JGB yield, it actually causes the yield spread to increase. All right, so what it means that this 2-year JGB yield, the reduction is but roughly move in line with the expectation of future Bank of Japan monetary policy stance. Why? Because the JGB 2-year is very, very sensitive to monetary policy stances by Bank of Japan. All right. So what it means that the 2-year JGB yield, or the 2-year Treasury, 2-year JGB, the 2-year Japanese government bond market is now starting to price in a less hawkish Bank of Japan going forward by the 2-year JGB yield that is actually shaping a series of lower high as inching downwards since its recent peak on 10th of February at around 1.31% and now trading at around 1.24%. So that actually explained to us why the Nikkei 225 managed to find support at the 50-day moving average after yesterday's Nikkei 225 futures sell-off during the US session is due to market now is expecting a less hawkish Bank of Japan as being expressed by the price movement of the JGB market, which I explained to you guys earlier, which means there could be additional liquidity that is likely to start to rise in the Japanese financial markets, which eventually will start to float into riskier asset, allowing the Nikkei 225 to find some form of support over here. All right, so that is the intermarket movement that actually explained to us why the Nikkei 225 is now moving away from yesterday's negative feedback loop that is not being triggered by yesterday's negative movement on the major US stock indices as seen in the other Asia Pacific stock market like the ASX 200, the KOSPI 200, and even our Straits Times Index, the STI over here. All right, so now with that covers the first segment of the daily dose. Now let me move on to the second segment, which is the intraday technical outlook segment. All right, so let me expand my screen so that you guys could have a better view over here. Okay, so let us start with the FX market first. So before I kickstart on the individual FX pair, the US dollar index continues to shape a bounce yesterday. So it managed to find support at this 98.55 level, which is this former pullback resistance that was previously from kept the boost in check since 21st of November last year and 19th of January this year, and it was taken out on the 3rd of March. And yesterday, it managed to stage a rebound after retesting close to it with a gain of positive 0.29%. And in today's Asia session, it was down slightly to negative 0.1%. So what we could see over here is that given that the support on the US dollar index continue to hold and is right above the 200-day moving average, there could be still a possibility of the US dollar index gaining further strength, at least in the near term, with the next key resistance zone to come in will be the major range top on the US dollar index since the high of 28th of May last year at 110/100.50. All right, so with that bearing in mind, let us now go into the intraday view on the 4 major US dollar pairs, starting with the euro dollar over here. So the euro dollar yesterday's it did that so-called that push down as expected, hit the first support level at 115.65, which printed a low at 115.59 at the US session, which is at 12 a.m. Singapore time today over here before staging some kind of bounce. So no change, still watching the pivotal resistance level at 116.73, which is the 200-day moving average as well. Still maintain that mild bearish bias on the euro dollar for a revisit to 115.65. Breaking down 115.65 will potentially expose the next near-term support zone at 114.95, 114.70, which is the 1.382 Fibo extension of this ongoing corrective decline since the high of 28th of January this year. And as well, looking back in time, will be the minor swing low of 21st of November last year and the minor swing low of 5th of November last year. However, a squeeze up and an hourly close above a 116.73 short-term pivotal resistance will invalidate this mild bearish view on the euro dollar to see a recovery towards the 50-day and the 20-day moving average, I think, as the next or conferencing near the next intermediate resistance zone at 117.40, 117.74 next. All right, so that will be the euro dollar. Next will be the sterling pound over here against the USD. So sterling pound also managed to inch lower, all right, and before staging the bounce. So right now it's back at the pivotal resistance that we highlighted. So no change, still maintaining that mild bearish bias view at 133.72, 134.04 short-term pivotal resistance zone. First support level to watch will be the low of this week at 132.65. Breaking down below 132.65 may expose further weakness, potentially towards 132.20. Below 132.20 may see a deeper slide towards 131.55, 131.25 over here. So first support still remains the same at 132.65, which is the low for this week. So 132.20 will be the 1.382 Fibo extension on this ongoing. Okay, I think it's still pushing properly. Okay, from the from this ongoing corrective decline since 28th of January, and 135.55, 132.35 will be the 1.618 Fibo extension. And graphically, if you look back in time, is the congestion area here of 19th of November and 26th of November last year. Okay, going back over here. So a breakout above 132.04 and an hourly close above it will invalidate this mild bearish bias on the sterling pound to see a squeeze up to retest the 200-day moving average that is confluencing with the next graphical intermediate resistance level at 134.50. Above 134.50 may see a push higher towards 134.23 with that confluence with the 50-day and the 20-day moving average as well. So that's for the sterling dollar, still maintaining a mild bearish bias below 133.72, 134.04. Next will be the Asia Pacific currency, the two major US dollar pair, the two major US dollar Asia Pacific currency against the US dollar, pardon me, starting with the Aussie dollar. So no change, the Aussie dollar continues to be trapped within this neutrality range. So yesterday we have the neutrality zone between 70.88 and 69.80. So indeed it tested 69.80 during the US session yesterday at 3 a.m. Singapore time before staging a rebound in today's Asia session, but still remains below the 20-day moving average, which is very close to yesterday's upper neutrality range as well. So with that, still maintain a neutrality stance for today on the Aussie dollar between 70.88 and 69.80 for now. All right. Next will be the dollar yen. So the dollar yen yesterday do a very choppy squeeze up above our Titan short-term pivotal resistance at around the 57 or 30 level, but managed to stop short at the this week high at 157.85 before it traded sideways again. So with that, potentially there is still no clear move trend on dollar yen right now. Okay. So I would flip to a neutrality stance due to the last 2 days of choppy price movement. So neutral between 17.85 and 17.15. So only a breakdown below 17.15. Okay, neutral between 157.85 and 157.15, which is 157.15. Only a breakdown below 157.15 and hourly close below it will potentially see some form of intraday weakness to revisit the 50-day moving average again, acting as a near-term support level or confluencing it at 156.17. All right, so only a breakdown below 156.17 may trigger a further potential weakness on the intraday visit to revisit 155.42 next intermediate support, which confluence with the 20-day moving average. So maintaining a neutrality stance for now between 157.85 and 157.15. Right, so that sum up the four major US dollar pair. Moving on, next will be the major stock indices intraday outlook, starting with the Hong Kong 33 that is representing the Hang Seng Index. So yesterday we do have a bullish bias on the Hong Kong 33 using these two support level, 25,060 24,765, which is my long-term pivotal support level. So price action now reintegrate back above the 200-day moving average and also breaking above yesterday's Asia session high at 25,704. So if we start to see an hourly close above 25,704, as we are speaking right now, it's still haven't closed the hourly mark yet. So now it's at 11:36 a.m. Singapore time. If you have an hourly close above 25,704 thereafter, then I will tighten my pivotal support to this 25,060 level. Right, so still maintaining my pivotal support, which is the long-term pivotal support for today at 24,765 for now, based on the current price action. Next resistance level to watch on the intraday basis, 25,960, followed by 26,350, which is the low upper boundary of this ongoing medium-term descending channel that has been in place since the high of 29th of January, and also confirms slightly below the 50-day and the 20-day moving average at 26,560 level. All right, over here. However, a price action suddenly, if we see a price action breakdown below 24,765, then all bets are off for this minor recovery scenario on the Hong Kong 33 that's representing the Hang Seng Index to see further potential weakness towards the next intermediate support at 24,257 and even 23,845, 23,680, which is the all the way down to the minor swing low area and the congestion area of 4th of July and 23rd of June last year, and also very closely the Fibo extension of 2 times from the ongoing corrective decline this year since 29th of January 2026. All right, so that's for the Hong Kong 33. Now, up next will be the Nikkei 225, which is the Japan 225, representing Nikkei 225. So what I could see is that it managed to stage 3 times survive. It managed to survive at the 54,100, 52,960, which is the current low that is being printed on this week, which is our medium-term pivotal support level as well. We're so close to the 50-day moving average and this minor ascending trend line from the low of 6th of February. And interestingly, what we could see right now is that the hourly RSI has managed to stage a bullish breakout from that previous lower high, okay, indicating some form of bullish momentum that is coming back at least in the near term. So with that, I would flip to a bullish bias, and also I share with you based on the intermarket perspective on the JGB market that has having a positive feedback loop back into the Nikkei 225, which I shared with you guys earlier, supporting our my intraday bullish view on the Japan 225. So using 54,100, 52,960, that is my medium-term pivotal support. Flip to a bullish bias for today. First resistance level to watch will be this week swing high area at 56,096, 56,530 over here, which is that above this 56,530 will potentially see a further squeeze up to revisit the 20-day moving average, although also that is confluencing with the next intermediate resistance level at 57,140. That also confluence with the upper limit of this ongoing minor descending channel that is taken from the current all-time high of 26th of February, all right, 26th of February this year. However, if price action punches down suddenly and breaking below 52,960, that would invalidate the minor recovery scenario for today and see the continuation of the corrective decline to expose the next supports level at 52,960, thereafter followed by 52,260, which confluence with the lower limit of this minor descending channel, and as well as the minor swing low area of 23rd of January this year and 29th of January this year. So that's for the Japan 225. Next up will be the Germany 30. So the Germany 30 managed to form a bearish reaction right exactly at yesterday's pivotal resistance at around 24,300, 24,350 before staging a bearish breakdown below this minor bearish flag formation over here and hitting the support level of the 4th of March minor swing low at 23,710. So with that, in today's Asia session, it now managed to stage a bounce. So with that, I would now have a tighten short-term pivotal resistance level, which is confluencing very closely with the 200-day moving average at 24,160 over here. And if you drew the pullback line of this bearish breakdown line of the former lower limit of the minor bearish flag, that also confluence with the pullback resistance of this bearish flag breakdown as well. So using a slightly adjusted downward short-term pivotal resistance for the Germany 30 at 24,160, maintaining that bearish bias view on the Germany 30, breaking down below 23,710 will potentially seek out a next intermediate support level to watch, 23,480, which confluence with the 26/1st of December 2025 swing low area. However, if price action squeeze up, it may revisit yesterday's high at 24,350. Only breaking above 24,350 will negate or invalidate the bearish buyer's view to see a corrective rally or a squeeze up extending further towards 24,715, 24,715, and even the intersection between the 20-day and the 50-day moving average. Okay, now at 24,886, that also confluence with the former minor swing low of 24th of February, where the rally got rejected on 2nd of March. All right, over here, let me put it in writing. 24,886. All right, so to sum up, still maintaining that bearish bias view on the Germany 30 that's representing the German DAX with a slightly downward adjusted short-term pivotal resistance, 24,160 for today. Next up will be the major US stock indices, starting with the US Wall Street 30. So the USA Wall Street 30, yesterday we do have this pivotal resistance that we highlighted, 48,775, 48,850. Yesterday price action at before the start of the US session, during the European session, it tested this level before that sell-off take place. But the sell-off managed to find support at the medium-term pivotal support area. So given the fact that there is no bullish divergence that's being formed on the hourly RSI, just only an exit from the oversold level. So with that, I will still maintain a bearish bias view on the US Wall Street 30 for today, given the fact that it hasn't broken down below 47,360 decisively. I do not want to tighten my pivotal resistance to be so tight. So pivotal resistance, there will be two levels to watch. One will be the former minor swing low of 4th of March at 2 p.m. Singapore time, got taken out, now turns into a first intermediate resistance to watch at 48,300. Maximum will be still at the pivotal resistance zone that we highlighted yesterday at 48,775, 48,850. So unless we have a bearish breakdown and hourly close below 47,736, then I would tighten my pivotal resistance to 48,300. So for now, pivotal resistance will remain the same at 48,775, 48,850, maintaining a bearish bias view on the US Wall Street 30 for today. After 47,736, the next support zone to watch will be 47,350, 47,270, followed by 46,925, 46,870, which is the 1.618 Fibo extension of this ongoing corrective decline taken from the current all-time high of 10th of February. And if you go back over here, is also the congestion area of 14th of November and 20th of November last year. However, a recovery and a squeeze up above 48,850 and hourly close above it will see a recovery scenario extending further on the intraday basis to revisit the 50-day and the 20-day moving average, acting as the next intermediate resistance level at 49,079, 49,360. Right. Next up will be the S&P 500. So the S&P 500 also did a bearish reaction right exactly at the 20-day moving average before breaking down, but managed to find support on the 4th of March, 1 p.m. Singapore time, minor swing low at 6,785 before rebounding in the last 2 hours of the US session yesterday. So with that, given that it hasn't broken below 6,785, two resistance level to watch will be at the first resistance level 6,848, pivotal resistance which we have yesterday at 6,907, 6,919 still stands for now. Unless we have an hourly close below 6,785, then I will tighten it to 6,848 for now. So right now, still having that that bearish view on the SPX 500. below 6,785 exposes the medium-term pivotal support in first step at 6,733, 6,720. A breakdown below 6,720 and an hourly close below it will expose further weakness towards 6,664, okay, which is the FIBO extension. I don't know why this FIBO extension got run out. Okay, over here 6,664, pretty close to the 1.238 FIBO extension taken from the current all-time high of 28th of January. So 6,664, if you go back, it's the graphical congestion area here of 21st of November and 25th of November. However, if price action starts to see a squeeze up above 6,919, then this minor recovery there will be a minor recovery extending further to revisit 6,972, which is the top of this range resistance, and also very close to this minor descending trend line that has been in place since the all-time high of 28th of January. So that's for the SPX 500, still maintaining that bearish bias view. Nasdaq 100, so the Nasdaq 100 also managed to see a rebound right exactly at the first support level, 24,774 over here. So with that, two resistance level to watch will be yesterday's high during the start of the US session at 25,170. Pivotal resistance that we have yesterday still remains the same, which is very close to the 50-day moving average and also the upper limit of this sideways range configuration that has been in place since 4th of February. All right, this is sideways range configuration. So using the sideways range configuration upper limit, which is my short-term pivotal resistance yesterday, maintain the same bearish bias for it to float down towards the bottom of the range again, 25,377, 25,430. Two key near-term support level, 24,774 for sure in the first step, followed by 24,500, then thereafter 24,333 / 24,140, which is the medium-term pivotal support level, and also the area, and this 24,333 is also very close to this key 200-day moving average. Right, so that's for Nasdaq 100. However, if we start to see a squeeze up above 25,430, then this there could be a potential minor recovery taking shape on the Nasdaq 100 to expose the next near-term resistance level, 25,580. Above it, seek out excuse me, 25,940, which is the minor swing high area of 30th of January and 3rd of February, where it triggered off a steep decline at that point in time to the low of 6th of February, which is the medium-term pivotal support level at 24,140. All right, so still maintaining that bearish bias view on the Nasdaq 100 within a sideways range configuration that has been in place since the high of 4th of February. All right, so that's for the Nasdaq 100. All right, so that's all, pardon me, that sum up all the intraday outlook on the major stock indices. Let us now move on to the commodities market, starting with Gold XAU/USD. So Gold XAU/USD continues to find support at the 20-day moving average at our 5,046 pivotal support that we highlighted 2 days ago, and also this lower boundary of this minor ascending channel that has been in place since the low of 6th of February. So no change in terms of the bias, still having this bullish bias given that it managed to survive at the pivotal support level, but intermediate resistance level will be lower today. There are two levels to watch: 5,192, which was a minor range top that has been formed on 4th of March. We call it 5 p.m. Singapore time, and 5th of March, 12 p.m. Singapore time. All right, so that's the minor swing high or the minor range top at 5,192. All right, so above 5,192 may expose the next intermediate resistance level at 5,280. So these are the two resistance level to watch. Only a breakout above 5,280 will potentially seek out a deeper, we call it intraday bullish impulsive up move sequence towards the upper limit of this minor ascending channel at 5,448 next, which is the 30th of January minor swing high. However, a price action breakdown below 5,046 will invalidate today's bearish bias view to seek out a exposure to the next intermediate support level at 4,960, followed by 4,842, which is the 50-day moving average over here. All right, so that's our so-called the intraday technical outlook on Gold XAU/USD. So next will be the West Texas crude oil over here. So the West Texas crude oil, as you could see yesterday, it cleared above 80.30 and now fast approaching the next resistance level at 83.60, 84.55 over here. So with that, right, the oil prices managed to stage a bounce. So yesterday we do highlight a key breakout level, which is 78.10. After breaking up 78.10, we see a steep acceleration on the intraday basis starting at Thursday, 5th of March, 11 p.m. Singapore time. Now it did a minor pullback, and this pullback seems to have ended after this bullish candlestick that's been printed at 9 a.m. Singapore time, Friday, 6th of March, as we are speaking right now, which is 11:55 a.m. Singapore time. So with that, two key resistance level, two key support level to watch to maintain our ongoing bullish biasness on the West Texas crude oil will be at 78.10. Pivotal support level will be slightly higher today at 76.15, moving up from 73.38 yesterday, and 76.15 also confluence with the lower limit of this minor bullish acceleration channel taken from the low of 26th of February and also the minor swing low that's got survived on 5th of March, Thursday at 5 p.m. Singapore time hourly mark yesterday. So using a slightly higher pivotal support level, 76.15, maintain this ongoing bullish biasness on the West Texas oil. Next resistance zone to watch, 83.60, 84.55, which confluence with the 2nd/18 July 2024 swing high, the 3.618 Fibo extension from the low of 17th of March, above 84.55, takes us up potentially higher towards 87 figure level /87.85, which is the 4.236 Fibo extension from the low of 17th of February and also the 5th/14th of April 2024 minor swing high area as well. However, a bearish breakdown below 76.15 and the hourly close below it will invalidate today's bullish bias view. Okay, I repeat again, still maintain a bullish bias on the West Texas oil with a tightened short-term pivotal support at 76.15. Only a bearish breakdown and the hourly close below 76.15 will invalidate the direct bullish bias view to kickstart a minor corrective decline sequence, exposing the next near-term support level at 73.38, followed by 70.70, which is the minor swing low of 3rd of March, and also the former major descending resistance of 28th of September 2023 high got taken out on this Monday, now turns into a critical pullback support level. All right, so that's West Texas oil. So that sum up all the intraday technical outlook on the broad-based cross asset classes. So let us take a look at the economic calendar. Other than the ongoing US-Iran conflict, there are some couple of important data to take note of for today as well. So today will be Friday, the 6th of March, 2026 over here. So over at the European session, we have ECB President Lagarde speaking at 6 p.m. Singapore time. So that would potentially could influence the euro dollar and the euro crosses. And going forward into the US session will be the all-important data, which is the non-farm payroll data over here. So for US non-farm payroll data, market participant is still expecting a low ball number this time around for the month of February. So market is expecting about only 50K, 59K jobs added, down significantly from 130K jobs added that was in the month of January. And the unemployment rate, market participants expecting it to be the same level at 4.3% over here. So if we start to see this could potentially influence almost all asset classes, given that the non-farm payroll data, which is a key labor market data, together with the unemployment rate that is closely watched by the US policymaker. So if we start to see a much more better than expected non-farm payroll data, so instead of a low ball of 59K, it starts to increase to about what, 80 or even 100K, that could potentially reduce the further odds of the interest rate cut bets. And given the fact that given the current context right now, we are seeing about inflation pressure coming back into the US economy, that could potentially further strengthening the US dollar as per se earlier on. And after the non-farm payroll data, it will be a rather quiet US session over here. All right. So with that, other than that, on top of that, over the weekend, we also need to pay a close attention to what's going on in the Middle East, and that could also potentially influence rather volatile opening session when Monday kickstarts again. So with that, I hope that you guys get some rest, given the fact of what of the current very volatile movement that is being seen this week on the global markets, and it may continue to persist further, given that both sides are not backing down. All right. So with that, I'm Kelvin here signing off, and we shall speak again on next Monday. Thank you.